Our next guest says he hasn't seen a yield move like this in his 2-decade career. Jens Nordvig runs Exante Data and is Nomura's former head of fixed income research. Jens, always great to see you. So, let's think about this. You're sitting in front of your computer. In 20 years, you haven't seen this sort of move. So in your head, what do you think about in terms of what breaks when you see this moving yields so quickly?
Well, like you always keep an eye on credit, right? Is the high yield starting to really impact the corporate bond market, and we've seen some of that. You look at what's going on with global credit conditions, and we've started to see some weakness in a lot of different credit markets. So it's been an accumulation of forces, and we've had some incredible moves. Even after the rally we've had today, right? We have an almost 3 sigma move on the week, even after the rally, right? So that just shows how incredible big these moves have been. And it also is something that the Fed clearly has started to take into account. We've had 5, 6 Fed speakers now make reference to the bond yields as something that actually means that they have less work to do themselves. They are taking it into account in financial conditions as well.
When Powell was speaking the other day at the New York Economic Club, Jens, he was asked specifically about foreign buyers stepping away. And he sort of dismissed that notion, even though on Wall Street, charts have been going around with China stepping away. I want to read the quote from Fed Chair Jerome Powell. Buying by overseas entities has actually been pretty robust this year. So there have been some small changes, but I think by and large, they've been buying robustly. Which seems to go in the face of what many people think on Wall Street, that, China's just not in the position to buy anymore. They don't have those excess reserves. Maybe politically, they don't want to do it either. And Japan is also stepping away. What do you think?
So when you analyze China, right, the big change is that they used to be huge buyers, and they're definitely not huge buyers now. Like, we can talk about exactly how much they're selling, but the big change is that they're not big buyers anymore, right? So we track Chinese intervention all the time, and we've had more intervention in August, more intervention in September, right? So the pace of reserve losses is maybe 30 billion a month now, and some of that's going to be funded out of Treasury. So there's probably some selling there. But I think really the big picture is that supply is going up, right? We need demand to go up somewhere as well. And it's not China for sure. It's probably not Japan either, right? So really, if you look at the big picture, it's actually the domestic U.S. investors have had to come in and fill the gap. And so far, up until very recently, the T-bills yielded way more than the bonds, right? So it's much easier to park your cash in the very short end rather than go out and take duration risk. Now that's kind of corrected, but essentially U.S. investors, households even, have been helping to fill that gap, and they've been doing it mainly through T-bills. And that's a part of the big reason why the long end of the curve, they had to kind of come up at a better yield point to suck in demand. And it'll be very interesting to see what happens when the yield curve has a positive slope. Is the demand dynamic going to start to shift? I don't think we've seen it yet, but that's one of the indicators we're watching right here.
Yeah, and Jens, to me, it's all about supply. It's also about a Treasury, U.S. Treasury, that I think was trying to hang into the short end of the curve, the T-bill issuance versus the 10-year. And we've said this. I mean, this is a Fed or essentially a government that's actually borrowing at really low rates and having to pay back and lock in at much higher rates. But let's go back. Let's go to your namesake and go to the currency markets. Yen kisses 150 today. I would make an argument that part of the move in Treasury yields could be even less Japanese participation. But it almost perversely, this carry trade is almost more attractive than ever when you look at the yield spread between the U.S. and Japan. But where are you on Japan, I guess, is where I'm rambling here. It just seems to me this is the next train wreck. And I think Japanese yields are the trigger to take U.S. yields up significantly higher.
Yeah, so all the markets are connected, right? So what happens in Europe matters to U.S. yields. What happens in Japan happens to U.S. yields. And Japanese investors have been massive buyers of treasuries over the years, right? The fact that the JGB yield is now edging pretty close to 1% in the 10-year and above 1% further out the curve is something that means that the Japanese investors don't have to come. So it's definitely going to have an impact, right? And we can certainly worry that we're going to have another relaxation in their yield curve control, right? So we don't have any anchor anymore. And that could be a factor for the U.S. Treasury market for sure. The one point I want to make, though, is that the U.S. bond market is not like its own thing. Like, what is going on with long end yield is intricately connected to what's going on in the short end of the yield curve. You can just see it today, right? The whole curve resets lower in tandem. It's not just the bond market doing something on its own, it's the whole curve, right? If the market could get comfortable that the Fed is done, then it's going to impact short yields and long yields, and that will be the most important force. And I'm not saying it will totally mean that the supply dynamics are not important, but it's going to be the most important driving variable, and we shouldn't lose sight of that. If the economy is weaker, if inflation is under control, the short end is going to dictate and be the most important force for the long end as well.